Hey, this is Ken at Capital Advantage Tutoring, and it's my job to get you past the Series 57 and maybe even the 24. This may go for both. I'm going to talk about the overview of the trading markets and stuff like that, market makers, stuff like that. So let's get into it. Now, remember, there are two markets. It's primary and secondary. The Series 57 is going to be mostly about the secondary market, and the Series 24 will be about both. So let's do a little chart to help us out. Okay, so you see we have listed up two markets. On the left, or you're right, whatever it is. On the left is the Act of 1933, the primary market. So think of the Act. 1933 was the first act, right, of these acts. So it's a primary act that covers a primary market. That's how companies raise money. They either issue common stock, which is ownership, and it's freely transferable, a lot of rights. That's what you see on TV. Then we have preferred stock, which is still equity, but it's more like fixed income. It doesn't have all the rights that common stock has, so it's not as volatile. It's more like a bond. And then they can raise debt, which is corporate debt. Either it's secured or a debenture, something like that. They raise money. That's how they raise money to build their business, right? So if I was going to go public, I would either do equity, which is the most conservative for me because then I don't owe anything other than to do the right thing by you. But if I do preferred or bonds, I'm more likely to I have some liabilities there that I have to pay you a dividend. Now, yes, a preferred isn't legally obligated to pay a dividend, but it's supposed to all the time. So that there's risk there. Right? There's a liability on there. But bonds, I am liable to paying. So bonds, even though the most conservative for the investor, they're the least conservative for the issuer. So that's issuing, raising money. They sell the security, they get the money, and then they spend it. Hopefully, I think the whole point is they want to raise enough money to do things to grow their business beyond what they have to pay back. So certain keywords you're going to see. If you see IPO, new issue, follow on, registration, cooling off period. I can't spell cooling off period. I have to change that. Isn't that funny? Let's just watch me. I'll change it. Boom. Here we go. Cooling off period. Syndicate process, underwriting, POP. Those are all keywords. Like if you see those words, you know we're talking about the Act of 33 and we're talking about the primary market. Also, if you see best efforts versus competitive, best efforts is the underwriter is going to do the best they can to sell the shares, but whatever they don't sell, they're going to give back to the issuer. So the risk is on the issuer raising the money because they may not get to sell it. Competitive is where, and that's more of a primary, a principal trade. Competitive is where we guarantee the underwriters guarantee to the issuer, don't worry, we'll sell it. So we want to sell 1 million shares. If we only sell 900,000, the underwriter is going to buy the other 100 grand guaranteed. Now, the reason I put gray market here, okay, it's a little fuzzy little thing. The gray market, and they made it so retail people can't do it, but the gray market is where stocks that haven't been issued yet trade and stocks that are halted trade. So what they did a couple of years ago, the SEC made a rule that they can't publish quotes for the gray market. So then retail people can't buy them because since if they're not registered or reporting to the SEC or fully allowed to be traded right now, they can't be quoted. So then you can't have retail people buy them. So the gray market, just it's a way for institutions, big time institutions, to trade stocks either before they're actually issued and IPO'd or when they're halted. And a lot of times, what happens is an issuer or underwriter will let it trade in the gray market to see to kind of see what kind of indications where it should be trading, stuff like that, to get an indication of demand for it. But again, the gray market isn't for us. But if you hear about it, don't freak out. It's legal. It's just not for retail people to buy. And again, it's just trading before the IPO is officially effective and if a stock is halted on an exchange. Okay, now we're into the fun part, the part that works for the 57. The secondary market is where shit trades, okay? So this is regulated by the Act of 34. So the Act of 33 does a primary market. The second act, which is the Act of 34, covers a secondary market. The secondary market is where all this stuff trades. So that's not the primary. Remember, the primary market, the reason Wall Street is around is to help companies raise money for their projects. So the secondary market is where the stuff trades back and forth. Okay, the first market is the exchanges, right? The New York Stock Exchange, NASDAQ, stuff like that. That shit is regulated out the ass. There's listing requirements. They're never going to test you on those. But you have to have a much higher standard. You have to be a bigger company, bigger market cap, a certain amount of shareholders, stuff like that. Those are all things to become listed. If you see the word listed, let's put it here, listed. If you're on exchange, you're considered listed. Now, specifically when they say listed, they really mean the New York Stock Exchange. But NASDAQ is an exchange now, so I think it falls under the first market. So the exchange, the New York Stock Exchange has a physical floor where they have specialists. We have a specialist or a DMM, their job is, so think about this way. So IBM, when I was down there for 30 years. IBM traded a post 4 section Q. I always remember that because it's 4Q, right? Sounds like a bad word. Chris Magaro was the IBM specialist. Every trade that was in IBM had to go through him. His job, and there'll be women and men doing it. Their job as a specialist or a DMM is to maintain a fair and orderly market. Unlike market makers, which we'll get to, they just have to be there. DMMs and specialists actually get rated badly if the stock is too volatile. So if there's a lot of buyers, they have to kind of sell it to slow it down. And if there's a lot of sellers, they have to kind of buy shares to keep it level. They are absolutely, their job is on the floor to maintain a fair and orderly market. That's their job. And they have a negative responsibility of, if it's going well, to stay away from it. They have a positive responsibility that if it's going bad, they have to get involved and try to make it better. Like, understand. So if you have Goldman Sachs walking in with 50,000 shares to buy right now, and then the only shares offered are UBS selling like 30,000 or 40,000, that means there's 10,000 shares that need to be bought to complete Goldman's order. So that could drive the price up. So the specialists will step in and sell the 10,000 shares out of their own inventory. Remember, specialists don't have customers. They are market makers, but they're called a DMM or a designated market maker. And it goes on the other side too. If UBS walks in with 50,000 to sell and Goldman only has 40, there's a 10,000 share imbalance. That might drive the price down. So the specialist or DMM will step in and buy the other 10,000 to complete the trade so it doesn't move it that much. That's what a specialist does on the stock exchange. On NASDAQ is a little different. We'll get into the market makers. They don't have their responsibility. Literally, market makers' job is to be there making a bid and offer, which we'll get into, reasonable to the inside market, usually within 8%, all day long from 9:30 to 4. But they don't have to, if it's going bad, they can move their quotes away. Like if they see a lot of buyers, they can raise their quotes to stay out of the way a little bit so they don't get ripped off, right? So that's the DMM has to stand there and face the bad stuff, where the market makers kind of don't. Now, second market is over the counter. So again, the first market is traded on an exchange. The exchange actually acts as a middleman, so that if you do a trade between JP Morgan and UBS, it's actually done with the exchange in the middle. So this way there is less, there's no counterparty risk, because they say JP Morgan flakes and disappears and doesn't want to do the trade. The exchange will honor it because it's locked in, and then they will nail JP Morgan. So that's where the exchanges come in and help out. The over-the-counter is literally me calling Goldman directly and hey, I heard you're in a stock. Here's your market. I want to buy some. Are you willing to sell it? So we call up directly. It's more electronic now, but it is literally one broker-dealer going to another directly and buying or selling at a negotiated rate. Now, the prices get traded. I mean, the over-the-counter is a little different because a lot of the stuff isn't real-time trading unless you pay money for it. But again, over-the-counter is Goldman or an institution, broker-dealer, buying from another broker-dealer over the counter means like over their desk. A lot of equities trade. If you're on over-the-counter equity, there's no listing requirements other than you have to be registered with the SEC. And if you're not registered, then you can really only trade on the pink sheets, one small department of these markets. So again, if you should be SEC registered, but if you're not, you can still trade just only in the pink sheets, okay, which are the lowest levels. Now, to be fair, if you are registered with the SEC, you can trade both the pinks and the over-the-counter bulletin board, but there's no listing requirements other than that kind of thing. So you don't have to have like a certain amount of shareholders or all this other stuff while my dog throws up next to me. Now, almost all debt now trades over the counter. There's a couple remnants that trade on the stock exchange, but they don't really trade on the exchange. They're just kind of listed there and they kind of trade electronically. Almost all debt is over the counter. It means dealer to dealer, okay? And we'll get into that as we go on through the later chapters. Now, that's the first and second market. Now, there's an alternative trading system. One of them is called the third market. Third market is also known as CQS, Consolidated Quote System, okay? Now, this is for trading, as I wrote down, it's listed securities trading over the counter, which means like if you have a stock, like say IBM, I'm going to stick on that. IBM, let's say IBM is trading on the New York Stock Exchange, and you see that on the stock exchange, it's offered at $40. And you go, oh, I can buy it at 40. And then you look a little deeper and you go, oh, wait a second. Goldman's offering it directly at $39.80 on their third market, okay? So what's going to happen is you'll go, oh, instead of going to the exchange, I'll go directly to Goldman and buy the shares from Goldman directly, like an over-the-counter trade, because I get a better price. So remember, listed securities trade on the exchange primarily. Over-the-counter trades over the counter. But then third market is like allowing listed securities that are on the stock exchange to trade over the counter directly broker dealer to broker dealer, and it leads to better price discovery. Okay, because if the Goldman or UBS doesn't want to put their bids or offers on the exchange, they can put it up on their own market make with their market makers, and they may have better prices. So that's the purpose of the third market, is to give an alternative to the New York Stock Exchange. I think it doesn't help. I think in the 90s, when everything had to go to the exchange, then all the best prices are there, and then you knew where the best prices were. You didn't have to search around for it. I mean, there's systems that fix it now called best execution, which we will talk about later. That's all about trying to find the best price, and you have to report it, and there's a lot of rules on that. The fourth market is just allowing for institutions to trade with each other. So understand, if you want to trade in the first, second, or third market, you have to be a FINRA member and a member of the exchange or NASDAQ or whatever it is. If you're not a member, then you can't trade. Okay, it starts with FINRA and then works to NASDAQ. So, but the fourth market allows non-members to trade, because like a hedge fund or a bank or a money manager or a pension plan or some mutual funds are not broker dealers or FINRA members, so they may not be able to trade. So if the fourth market allows that, because what the broker dealers do, they set up these like systems called ECNs, and the institutions trade through these ECNs, these electronic platforms. They give the institutions access to the markets, so they can act like they're broker dealers. It's still going through a broker dealer that gives them the platform, but it's like they can live trade. And now some of that's called like market access, where a broker dealer is giving access to a non-member. And there's a lot of rules on that. You have to make sure they don't have errors and stuff like that. Again, we'll get to that in the later chapters. Okay. So ECNs, a dark pool. Dark pool is very interesting, right? Mechanically, I don't see why, but it's like you can put orders out there and nobody knows they're there. So like, say you see a bid of 40 and an offer of 42, and you go to buy shares thinking you're going to buy stock at 42, and all of a sudden you buy it at 41. You go, how'd that happen? There was a dark order. Okay. A dark order is orders that are out there, but nobody can see them until you place an order that executes against it. Again, we'll get more into it later. But dark pools are basically putting your order into this black box, you want to say. And if there's another person who has the same order on the other side, so let's say you go and you put in the black pool and this dark pool, buy 10,000 shares at $40. You put it in there. Nobody knows you did other than you in the system. If a seller comes in to sell 10,000 shares at 40, or maybe even 5,000 or 8,000 at the same price, it'll match up and you'll trade, but you will not know who the other side of the trade is, because you just get a report later going, oh, you bought 5,000 shares, but you don't know who took the other side. So that's a dark pool. There's advantages to that. So you can put orders in there without people knowing, because what happens is sometimes if you see like Goldman or UBS is buying every day, and they're buying a lot, you're going to start reacting to that. So you go, oh, Goldman's coming in. I know they're going to be a buyer. I'm going to raise my prices raise them higher, so they have to pay more. So this kind of avoids that. That's why also some broker dealers use what they call a broker's broker, or they use like a non-attributable quote, so you don't know who they are. Again, all this stuff will be explained in the later chapters. So make sure you watch the later chapters as I push them out. So again, dark pools allow for like trading without people knowing the orders there. Hope that wasn't too fast. Hope that wasn't too complicated. I got more shit to do. Don't go away. Let's try it again. Don't hate the player, hate the game. No, we're going to talk about the players in the business right now. Like, what's a broker dealer? Okay, so let's talk. If you've taken the 63, then you know the definition of it's a firm or it's a person that affects securities transactions for themselves and others. That is what they are. So a broker dealer is a firm that is engaged in the business of affecting transactions for securities for themselves or others. Okay, now, the broker dealer word is like broker dealer. Okay. So the broker end is where they act as an agent, where they're doing it for others. A dealer is where they're acting as a dealer. They're trading their own account. Now, they may still have customers on both sides, but the broker part, remember ABC, agent, broker, commission. So if you're an agent in an agency capacity, you're acting as a broker, you're charging a commission because you're just acting as a middleman. But if you're on the principal side, PIDM, I call it PIDM, right? Principal, inventory, dealer, markup. If you see any of those words, they go together. So if you're acting as a principal, you're actually using your own inventory to buy. So if a customer buys, you'll sell out of your inventory and charge them a markup. If your customer is selling, you'll buy it into your inventory and charge them a markdown. So the dealer is using their own inventory. Okay, so let's talk about the different departments of a broker dealer. Investment banking, it's basically that's where the broker dealer works with the issuers to help them make money, get financing, stuff like that. That's their job, is to get all this different financing. That's what investment bankers do. That's more primary market, raising money for capital. Okay. Research is where they do research and they analyze stocks and they tell you whether to whether it's oversold, and they go buy or sell or hold. They give opinions. Okay. Sales are just selling. They're just boom. They're brokers. Those are the guys you see on Wolf of Wall Street. Hey, oh, the Goombas from Staten Island making phone calls and trying to sales. Trading is what I did. We're trading. We're buying and selling either for our clients or for our firm. Like my first 25 years, I worked in the stock exchange. We were trading for some of our clients, but sometimes just the big houses. If I worked for like a Bank of America, JP Morgan, stuff like that. Or then when I was running the prop trading firm, we didn't have customers. We literally traded our own. I had 350 traders trading our money. That was that. The operations department is the one who does all the back office, moving the funds, the securities, the margin, clearing, all that stuff. Those are the different departments. We have investment banking, which helps companies raise money. We have research, which is giving buy and sell and hold warnings and research and stuff like that. Sales, they're actually selling the shares. Trading, they're buying and selling for their customers or whatever. And then operations is the back office, which is like the margin, the stock loan, which I did the video on. All the back office paperwork stuff. Okay, Reg NMS, National Market System. This rule made all the exchanges and all the listed securities had to be interconnected so we could get best execution. So it used to be like, we had the New York Stock Exchange, we had the P Coast, we had the Midwest, we had Boston. They weren't really connected, so you had to call them. Now they're all connected on the same system, and this ensures, or supposed to ensure, that you get the best price, the best execution. So Reg NMS is for listed securities, and it's all for it's to keep everything connected, all the different exchanges connected, as I can't speak, and trying to get make sure we get the best price. Reg FD, fair disclosure. What happened was they don't, prior to this coming out, I think it was early 2000s or late 90s, issuers would meet with like their top companies covering them or something like that, and have a breakfast meeting and tell them stuff that maybe wasn't disclosed to the public. So that was called the selective disclosure. And then these research people at these firms would only give that information to their biggest clients. So fuck us, right? So fair disclosure came out and said, oh, you can't do that anymore. So now what happens if you disclose something that somebody can make a reasonable belief that they can make a decision on, then you have to disclose it to everyone, usually on an 8K or within 4 days. But if it's material, it has to be within 24 hours and before the next trading day. The problem with that is shit trades 24 hours, but that's the rule. So if you disclose something by mistake, you have to disclose it within 4 days. But if it's material, then it has to be within 24 hours or before the next trading day, whichever comes first. Okay, we're normally doing like definitions here. Okay, so let's say, what's a bid? The bid is where people are willing to buy. So let's try to get up on the screen, see if that'll help a little bit. Okay. So let's say we have, I'm willing to pay $40 for 1,000 shares. I'm bidding $40 for 1,000 shares. That's the bid. And let's say you guys are saying, well, you know what? And I'm not doing the whole market maker thing. That'll come later. Say you guys go, you know what? We want to sell stock at 40.1, $40.10, and we'll sell 500 shares. And normally that would be a 5 and a 10, but I'm just doing it to show that, because normally when we quote, it's how many round lots there are. So 1,000 shares is 10 round lots. So you would normally see the quote like this: 40 for 10. That would be real. We know that's for 1,000, and this is a 40 for 5. We know that it's only 500. That's the way it's quoted, but I'm going to do it here just so you can see the size. So this is the bid. This is the price. There's a price quote. This is the bid I'm willing to buy. So right now, if this is the inside market, I am the highest bid in the world. I'm willing to pay the most out of anyone. There is no one willing to pay at this snapshot in time as much as me. So if you want to sell stock, you have to sell it where someone is willing to buy it, and that's me right now. So if you want to sell stock, you sell at my bid, which is 40, okay? Now, the offer side is where you're selling it. You're willing to sell 500 shares at 40.10. Let's say that's the lowest offer also. So the inside market is the NBBO. It's also called, it's the highest bid and the lowest offer, or ask. Ask and offer mean the same thing. Bid and bid means the same thing. So buy. So if you're offering 500 shares at $40.10, that means you're willing to sell it at 40.10 and not lower. So if I come up to you and say, hey guys, I want to buy stock at 100 shares at 40.09. You could say yes, but you don't have to, because you said, no, I'm selling at 40.10. And you could say to me, if you really want to buy it, you have to pay my price. So remember, you can only buy where people are selling, and you can only sell where people are buying. So if I come in with a buy order and I want to buy it right now with a market order, I have to pay $40.10. but I can only buy 500 shares there because that's all that's offering. If I want to buy more than that, I may have to go to a higher price with other offers, which we're not talking about yet. You know what? Let's put that in there. So let's say maybe somebody else is offering, 4001 for 200 shares. And then maybe behind that is 4013. Doesn't have to go over a penny for 100. Okay, whatever that is. Okay. So if I wanted to buy 700 shares at the market, I would buy your 500 because that's what's offered. And then I go, I still need 200 to buy. So I'd search for it and boom, I'd buy 200 here. Then if I did that and they were gone now, this becomes the best offer. So it goes 40 bid. I buy 500 at 10. I buy 211. Boom, this is now the best offer. So the inside markup becomes 40 by 4013, 10 by 1, which is really 1,000 by 100. Okay, so if you want to buy stock, you have to buy it at the ask. If you want to sell stock, boom, that's the highest buyer right now. So that's where you have to sell it. If you want to sell it at 4001, sure, go for it. But there's no reason that you're going to sell it because as of right now, no one's willing to pay that price. Okay, so let's talk about different things. I kind of showed you a market order is like, hey, I want to buy stock. I have videos on this, but a market order is when you go, hey, I want to buy stock or sell stock. Price is not a problem. I'm just going to buy it. I'm going to buy it at the lowest ask or sell it at the bid. That works. Now, a limit order is like I talked about before a little bit. Let me put it back up. If you send me an order to buy 100 shares. And by the way, nobody says take a limit order. It'll just say buy anyone who says that doesn't work in the business. Buy 100 ABC at 40.01. That's a limit. That means you're willing to buy, whoever places order is willing to pay 40.01 for 100 shares. Well, now here's the thing. If I take that order, that's actually better than this one, right? So I'm going to have to, so the new best bid is going to be this. $40.01. And then my order that I had actually goes behind you, 40 for 1,000. I'm no longer the best bid. That's your limit order. So you just change the market by placing a limit order. A limit order is saying putting a price on it. Now, if you say a seller comes in and says sell, 100 at 40.10, let's say it matches what's on the offer. Well, all the market, and we'll get heavier into this later, but the market maker has to reflect that. So dog's about to bark. There it is. So I have to reflect that and adjust that. So you're going to deal with it. So I'm going to have to show 40.10 for 600 shares, which reflects your 500 plus the dog plus the customer's 100 shares. Hope that helps a little bit. That's bid. That's limit orders. That's bid and ask. I'm going to add one more thing on here because I'm going to put my bid ask thing so you see the stop orders. I'm not going to waste time with that. I've done that a million times. I'm almost ready to shoot myself for that. So I'm going to put a link up here for stop losses and the slobs over bliss. But I want to show you something. This is interesting. There's a thing that you probably didn't read about with the 7 of the other exams called a marketable limit order. So a limit order, okay, right here, 40.01. It's not really executable right now, but let's get into it. Let's get back to where we were. Okay. So a marketable limit order means it's still a limit order, but it's immediately executable. So I'll say I place an order to buy 100 at 40.1. That means I'm willing to pay 40.1 for it, but I have a limit. But look, it's offered right there. So if I want to buy 400 at 40.10 and it's offered there, that's a marketable limit order. Okay. So by 100 at 40.1 and it's offered at the same price, that's a marketable limit order, which means that it's executable when you place the order. Okay. Good. Now remember one thing, there's a priority of orders. Orders come first. So market orders always come first. So if 2 orders come down at the same time, one's a market order, one's a limit order, market order gets executed first. That's always the case. Market orders always execute first. Always. Okay. Now, that's good. We got that good. We don't need to expand on it too much. When we do priority of orders, market orders come first. Then if 2 limit orders come in, it's going to be highest prices first. We know that highest price comes before the lower price. That's fair. So market orders first, and then we rank them by price. So a buy order, the higher price goes first, and then the lower price. That makes sense. On the sell side, the lower price goes first, and then the higher ones go after it. What if they both come in at the same time? Let's change it up. What if they both come in at the same price? Then it's whoever comes in first. So if I came in a half second before you did, and we're at the same price, my order's ahead of yours. But what if we did come in at the same price and then the same time? which is hard to do right now because they're down to milliseconds. If that actually happens, size wins. The bigger order goes first. Weird, right? So market order gets priority, and limit orders best price, either higher price on a buy or lower price on a sell, gets priority. If they are same price, the first time takes precedence, the first one in. And then if they're the same time and the same price, which is nearly impossible now, it's going to go by the biggest order goes first. Okay, so we know with the limit order, market order, all that stuff, and I have the link there to go over it better, the slobs over bliss stuff. But sometimes when they place orders, you have to know how long it's going to be for. So, like a day order, if I call you up and say buy 1,000 shares at 40, that's obviously a limit order. I don't say it, I have a number, but it's automatically assumed that it's only good from 9:30 to 4 on that day, 9:30 a.m. to 4 p.m. on that day. Not, it doesn't go beyond that. So if it trades at your price at 402, you're not going to buy anything unless you what they call called a system day order or an extended hours, right? So you can check it and say, I want to be able to buy stock even after the bell up until about 8 o'clock. Usually, you're as a retail person, you're not going to do trades at 9 o'clock, 10 o'clock, 1 in the morning. So a day order is assumed 9:30 a.m. to 4. If you want extended hours, it can go all the way out to 8. Okay, you can also call it a system order, which is basically from technically 4 a.m. to 8 p.m. You can enter orders as early as 4 a.m., but they don't get reported. The system isn't actually open until from 8 a.m. to 8 p.m. to report trades. So now we have another type called the GTC, good till cancel. It's literally good until I cancel it. So if you really like a stock and you want to buy it at 20, but it's trading at like 25, you don't think it'll hit there today, but just in case, you say buy 100 shares at 20, GTC. Good till cancel. That means it's good until I cancel it. Now they update it every 6 months to make sure you still want to do it, but it's always going to be there. And that's a question. So when we put orders in, remember we talked about priority, right? What comes first? Well, when you put a limit order on the book, it's an order. Who comes first, second, third, fourth? Well, 99% of orders are day orders. So what happens is if I place an order to buy 1,000 shares at 40 and I'm in line, maybe there's 2 people ahead of me, 2 orders ahead of me, maybe 30 orders ahead of me, but there's also going to be some behind me. Okay. So we go in order. Now on the stock exchange, the New York, there's a way around that because you can actually pay a broker to stand in the crowd and then they trade, they kind of split. What happened is the order on the book could be willing to buy 1,000 shares. You'll walk in there with 1,000. And when it's shorter trades, you'll get 500 and they'll get 500. But if you don't have an actual broker standing in the crowd, you have to do it in order. Okay. It's basically time priority order for the most part. If we want to, say we have a day order, okay? Say you have a day order, buy 1,000 shares at 40. There's, 10 people ahead of you, 20 behind you. And you go, you know what? I want to make it a GTC order. Well, you don't want to change it right then because if you change it, when you change an order, it's not like you just adjust it. It's called a cancel replace. So if you place an order and you go, oh, I want to change the price, the amount or anything, you have to cancel what you have and then replace it, which means you're here and then you cancel it. You go out and then back in at the back of the line. I always think about when I was a kid, when you stood in line to buy concert tickets, right? If you got out of line, you got out of line. I don't care what you did. You got out of line, boom, closed up, you're out. You got to jump to the end of the line. So that's the way that goes. So if you're going to have a day order and you want to change it to GTC, you don't change it then. You wait to the end of the day, just in case you may get executed. And at the end of the day, 99% of those orders will disappear because they're mostly day orders. Then you place a GTC order and boom, then you're in. You might even be first or second in line for the next day. So again, if you're going to change an order, you don't change them. We change them on our end, but on the order book, it's called a cancel replace. Also, we can have a do not reduce, which means I think I talked about it. I would say call it do not resuscitate, DNR. If you place an order below the market, either a buy limit or a sell stop, and they do a stock split or stock dividend, there you should know this by now. They will adjust the price unless you mark it DNR, which they will not do. Okay, not held order. It's like giving you limited price and time discretion. If I call you up and say buy shares not held, I'm letting you, the broker, choose during the day, only the day without discretion, only during that day of when to buy it. You may go, you know what? I think the market's coming in a little bit. It's going to come down. I'm going to wait and see if I can get a better price. Or if I think it's going to go up a lot, I'll buy it now. You're letting the broker use his discretion. It's not the same as power of attorney. This is really just time and price discretion. Unlisted trading privileges, I don't know if I talked about this already, but UTP, unlisted trading privileges, allows securities that are on one exchange, okay, to like Reg NMS stocks to trade on another exchange. So like Tesla trades on the NASDAQ. They can use UTP to actually trade on the New York Stock Exchange. Same thing with Ford, trades on the stock exchange. it can also use unlisted trading privileges to trade on NASDAQ. This is not normally for over the counter. Okay, so these are a bunch of market makers. Now remember, market makers are broker dealers that their job is to maintain a firm two-sided attributable. What does attributable mean? Attributable means that it's a quote with your name on it. Like this right here is like a an MPID, which we'll get to later in the book. An MPID is an identifier that you use when you're placing quotes so you know who the order is. Bank of America, Credit Suisse, Merrill Lynch, CIBC. Those are all different market makers, and they all have to have a bid and offer on the inside market within a range, usually around 8% of the inside market, depending on the stock, and go bigger or smaller. Not smaller, but bigger. So they have to maintain a firm two-sided quote, which means firm. They have to be willing to buy and sell at a price. Now, since I didn't put amounts here, let's assume they're all 100. So when you want to talk about the inside market is going to be the highest bid. In this case, should be, I made them up, 40.05. Let's put a little, we'll put a little circle, real circle around there. 45, my highest bid, and my lowest is 41. So that's a pretty big spread, 95 cents, but we're going to stick with it. So that's the biggest, that's my inside market, 40.05 and selling at 41. That's where we are. So if you want to buy stock right now, you pay 41 and your markup will be based on 41. I add to that. And if you sell stock, and we'll get into heavier on that, if you sell stock, you have to sell it at 40.05 and your markdown will be based on 40.05, not the other prices. Even if you sell to Credit Suisse at 40.05, the markdown will be based on 40.05, not 39.90. So these are firm two-sided quotes. Now, let's talk real quick about one thing. So when we place quotes, we can't do what they call do cross the market or cross the market or lock the market. So this is what would happen. Let's say we're going to do, we'll call it old school Lehman Brothers. Okay, so Lehman Brothers. Now remember, this is the inside market, right? So the inside market is 40.05 by 41. Lehman cannot enter a quote that would violate that, meaning they can bid up to 41, up to 40.99, and they can offer down to 40.06, but they can't cross it or lock it. So if they put in a bid, 41 bid by 40, 41.50, well, the sell side's fine, but look, they're willing to buy it where someone's willing to sell it. So that would be a locked market. Now, what would happen is Lehman's quote would be automatically executed. Now, if you place an order to buy stock at 41, that's not a problem, but you can't enter quotes that would lock or cross the market. So locking it, boom, you're basically trying to place an order to buy, a quote to buy at the same prices where someone's willing to sell. That doesn't work. So they would automatically, it used to actually lock up the screen and you couldn't do anything while they were trying to fix it. Now, they just execute the order. Now, if you do too much, you get in trouble. But that's either way, you're not allowed to do this. But they fixed it by it would automatically execute at 41. Because Lehman is saying, I want to buy stock at 41, while at the same time, Credit Suisse is saying, I'm willing to sell it at 41. Credit Suisse has the inside market. So if Lehman enters a quote that would lock it like that, it would be a violation. Also, if they entered a quote 41.01, that would cross the market. So locking the market is you're placing a quote, a buy quote where the offer is, or a sell quote where the bid is. So we also, Lehman, I'll show you that one. Now, this is crossing the market. Crossing is you're placing a buy quote above the lowest offer. Because look, Credit Suisse says we'll sell shares at 41. You're placing a quote that you'll buy it above 41. That doesn't make sense. But what happens again? They just execute. Boom, it would just execute and they get in trouble. So that's locking or crossing on the buy side. Now do the sell side. Let's change this up to make it a legal quote. Make it 40. Make it 40, okay? And then let's make this 40.05. 40.05. Now that, look, now where's the highest bid, right? Let me get rid of some of this stuff. Let's see if it works. If I don't screw it up. There we go. Okay, now we saw the inside market. 40.05 is, so Lehman's placing an order to sell, an offer to sell in their quotes at the same price Bank of America has a bid in there. So that's no good. That's locking the market. It would automatically executed. Lehman must sell their stock and get in trouble. The same thing on the crossing. If they said, okay, 40.04 or even lower, and then that would cross it because you're offering it lower when then the highest bid is. So let's go back to this again. Locking the market is when you place a buy quote equal to the offer price that's out there, or you place a sell quote, a sell offer at the same price the bid is there, the same price. Now, a cross market is when you place a buy quote above where it's offered, or you place a sell quote below where it's offered. It kind of causes problems. So that's a locked or cross market. This is the inside market, stuff like that. Okay, let's recap some of the players, right? The investor is the customer, the person buying or selling. They don't have rules, okay? Then market makers are part of broker dealers where their job is to have a firm two-sided market from 9:30 to 4 every day. We're going to get heavier into that. I just want to have the definitions. So a market maker is a firm that has a bid and offer from 9:30 a.m. to 4 p.m. every day in the stocks they're making a market in. They're going to act as a principal. They're going to buy from their inventory when there's a seller, and they're going to sell from the inventory when there's a buyer. Then there's a DMM or a specialist. That is a market maker that is on the New York Stock Exchange, okay, or even the the options exchanges. And their job is to actually maintain a fair and orderly market. They don't have customers. They stand in a stock. Each stock has their own. They can have multiple stocks they run, but each stock that has their own DMM, they will buy and sell as the day goes on, and they will try to facilitate imbalances. If there's a lot to buy and only a little to sell, they'll make some sales to match it up. If there's a lot to sell, they'll make some buys. If they're trying to sell and there's not a lot of buyers, they will buy stock to even it up a little bit. And remember, broker dealers can act as either a broker or a dealer, right? Or a market maker. So you remember the ABC, right? If they're acting as an agent, they're acting as a broker, they're a middleman, and they charge a commission. If they're acting as a dealer, they're using their own principal, their own money. They charge a markup, markdown. And a lot of times they're just market makers. So market makers are always acting in a principal capacity. Brokers are always acting as an agent, like a middleman. Okay, that's the first one. Okay, that's the first one. We'll get going. I should have a lot out by the end of the week.